As you learned in the previous video, nearly every company out there actually prepares their statement of cash flows using the indirect method of presenting the operating section. This is the sample daycare statement of cash flows that we prepared together earlier, and we used the direct method for this section. We were able to do it very easily by just looking at all of the transactions that impacted cash and classifying them as operating, investing, or financing, and then we just put the operating ones here. But most companies have so many cash transactions that is impossible. So instead, they get to this same operating cash flow number by starting with net income and making a series of adjustments. Take a look at the handout associated with the cash flow video to see an example of a statement of cash flows using the indirect method of presentation just for this section. What I want to show you now is a really useful technique that I'll call an accrual to cash flop. It's a way to take these numbers that are on the income statement and convert them to their cash basis, so that what we would end up with after doing our flop is the information that this $53,000 in accrual basis revenue recorded on the income statement is the equivalent of $18,000 of cash collections from customers. Remember, most companies don't prepare this direct method cash flow statement, so it's very difficult to get that information if you don't know how to do an accrual to cash flop. So I'll provide for you a useful little tool to make the process a little bit easier. Before we go through and convert all of the appropriate income statement numbers using the sample daycare data, I wanted to talk just a little bit about the theory behind this tool that I'll be sharing with you. So to make it super simple, let's just start with an example where we have a brand new business and all of their services are offered on credit. So you can see here I've set up the equation for you, and I've done some transaction analysis here in the accounting equation. So we're assuming that only these two transactions have taken place. The company recorded $100,000 in sales revenue. Those sales were sales on credit. So since it's a new company, the beginning balance in accounts receivable is zero. Here we record our sales revenue using the revenue recognition principle. All the revenue is recognized immediately. So accounts receivable goes up and retained earnings goes up for that sales revenue. Then later on in the accounting period, the company collects $98,000 of those accounts receivable. So cash goes up, accounts receivable goes down. The ending balance in accounts receivable is $2,000. Well, the numbers that I've highlighted here, assume for a moment that you do not have access to the detail, to the actual transaction analysis. The numbers that I've highlighted here would be the numbers that would be available to you on the financial statements. You would of course see $100,000 of revenue on the income statement, and you would see on a comparative balance sheet that last year's ending balance or this year's beginning balance in accounts receivable was zero. Again, here I've simplified, it's zero because it's a new company. And the end of the year balance in accounts receivable is $2,000. If you have that information, we can convert this $100,000 to what cash collections must have been. If you start with your income statement accrual basis number and you adjust it for changes in related current asset or current liability accounts, you can arrive at what cash collections must have been. So here we see that the change in accounts receivable was an increase of $2,000. To do our accrual to cash flop, we would start with our $100,000 of revenue and we would subtract the increase in accounts receivable of $2,000. And that would give us our solution. Cash collections from customers must have been $98,000. Now, how do I know to subtract the $2,000 increase in accounts receivable? Well, here we know the answer is actually $98,000, so that makes it obvious. But logically, if you sell $100,000 worth of stuff and your accounts receivable increased during the year, then that means you must have collected less than you sold. So it makes sense to decrease your revenue number when your accounts receivable increased during the year. Likewise, if your accounts receivable decreased throughout the accounting period, then that means you must have collected more cash than you recorded in sales revenue. So let's take a look at this little tool that I referred to that will help you quickly sort through that same kind of logic. What we just did is convert a revenue account, sales revenue, to cash collections on account. The way we would do that is if the related current asset account, in this case when you're talking about sales revenue, one of the big differences between sales revenue and cash collections, the difference between those two things, a good deal of it ends up in that accounts receivable account. So here where it says current asset, we're talking generally about accounts receivable accounts. So our tool says if there was an increase, the change in balance was a positive, it was an increase in the related current asset account, accounts receivable, the tool says subtract that. If accounts receivable decreased, we would add the change in accounts receivable to our sales revenue in arriving at cash collections. So you're going to have one or the other of these two adjustments here. Now, another difference between cash collections from customers and sales revenue would be the situation where a customer paid in advance. So another reason why there's a difference between cash collection and sales revenue is the existence of that current liability account, unearned revenue. Notice that the signs for dealing with the current liability account are the opposite of the signs for dealing with the current asset account. So if a company starts off, we can do another simple example. If a company starts off a year, brand new company with a zero balance and unearned revenue, and they get paid $50,000 in advance from a customer, and they only earn $20,000 of that during the year, their income statement would show $20,000 worth of revenue. To convert that to cash collections from customer, you would have to add the ending balance, the increase in the unearned revenue account. It would go from 0 to 30,000 during the year. You would have to add that $30,000 to the 20,000 of revenue, and you would end up with $50,000 cash collected from customers. If the unearned revenue account decreased, you would subtract the change in that account balance. Now again, my simple examples had assumed a zero beginning balance in the account. Remember that we're not adjusting for ending balances in those accounts. We're adjusting for the increase or decrease, the change in those accounts. We can actually do the same thing for expenses. For expenses, all of the signs just reverse. So if you can remember the simple example that we started with a few minutes ago and just work through the logic that this sign would be a subtraction, brand new company, if they provide more services than they collect on account, you would need to subtract the increase in accounts receivable. You can certainly quickly build this chart for yourself by just thinking logically. Liability signs would be the opposites of assets. Expenses would be the opposite of revenues. Now, if a company were actually preparing the operating section of a statement of cash flows using the direct method, they would use some little chart like this, and they would actually have to look at every single income statement account and do this type of flop to get that number for the operating section of their cash flow. Remember, they're not going to look at every single transaction in the cash account because generally there's way too many to go through that type of process. In our case, I would just like you to be able to do an accrual to cash flop for various accounts. So I won't have you prepare an entire operating section of a statement of cash flows, but I think you ought to be able to develop and utilize this skill. So we'll take some of the income statement numbers from the sample daycare income statement and convert them to their cash flows, and you'll see that the cash flows that we come up with using this tool are the same cash flow numbers that you already saw on the statement of cash flows when we prepared it by actually going through transaction by transaction and labeling those cash flows. Okay, well, let's go ahead and use this little tool on the sample daycare information, and we'll start with that daycare revenue account. Since we're doing an accrual to cash flop on a revenue account, we only use this column of our tool. We'll only use the expense column when we're converting an expense account. So the daycare revenue account, go back and take a look at the income statement. On the income statement, daycare revenue was $53,000. The next thing we want to do is think about what kind of current asset and current liability accounts hold the difference between revenue and cash flows. Well, for revenue, it's generally two types of accounts: accounts receivable and unearned revenue. So we go now and we look at our balance sheet and we determine the change in accounts receivable and the change in unearned revenue if those accounts exist. Let's go take a look at the balance sheet. Here's accounts receivable. At the beginning of the year, there was $1,000 in the account. At the end of the year, there's $45,000. That's a $44,000 increase in accounts receivable. Since it's an increase in a current asset, we use this. We know we need to subtract that $44,000 increase in accounts receivable. So remember, this sign is telling you what to do with a change in a current asset account. It tells us to subtract it, so that's what we're doing here. Then we go and we look to see if there's any type of current liability that would be related to recording revenue, and we know to look for unearned revenue for that. Sample Daycare does have unearned revenue. Beginning of the year balance was $0. End of the year balance was $9,000. That's a $9,000 increase in a current liability. Since it's an increase, we use this sign that tells us to add the increase in unearned revenue. Mathematically, $53,000 minus 44 plus 9 gives us $18,000. And in fact, if you go back and look at the transaction analysis, or you look at the statement of cash flows that was prepared using the direct method, you would see that cash collections from customers during year 3 was $18,000. Now remember, this number is not normally available to you on financial statements because most companies prepare this section using the indirect method, not the direct method. We just use the direct method because since we had such a small company, it was easy to do. And theoretically, it's simpler as well. Let's quickly go through some other examples here. For expense accounts, one of the expenses that Sample Daycare had on their income statement was rent expense. So go back and look at the income statement. You'll see this $1,500 of rent expense. What type of current asset and current liability accounts would hold differences between what gets expensed for rent and what gets paid for rent? Well, the differences would generally be in two types of accounts: the asset account, prepaid rent, or the liability account, rent payable. In this case, Sample Daycare only had prepaid rent. So go back and look at the balance sheet. You'll see the beginning balance in prepaid rent was $300. The ending balance was $2,400. So there was an increase in prepaid rent of $2,100. Our table tells us if there's an increase in a current asset and prepaid rent is a current asset, we should add that to flop to the cash reflection of rent expense, or rent paid in cash. So $1,500 plus $2,100 gives us $3,600 of rent expense. Now notice that I'm using positive numbers here. So even though rent expense decreases retained earnings, I'm starting off with the standard presentation of if your rent expense is a normal positive rent expense, standalone balance in the account, you reflect that as a positive number. So you start out by showing your expense numbers positive, and you'll end up with cash paid in rent. So this is $3,600 of cash paid in rent. So this isn't the sign that you see in the accounting equation. These are, well, this one is an account balance. We can do a similar thing with interest expense. Interest expense on the income statement was $900. There was no interest receivable, which would be generally the related current asset account, but we did have interest payable. That should be IP instead of WP. We had interest payable of $900. It started the year off at $0, ended the year at $900. So there was a $900 increase in interest payable. Since we have a current liability that increased, our chart tells us to subtract that, and our ending result is cash paid for interest would have been $0. And if you look back at the sample daycare transactions, you'll see that's true. This $900 of interest expense was just interest that was accrued in an adjusting entry at the end of the year. Let's do one more. It's slightly more complicated. Let's take a look at supplies expense. This one's a little more complicated because of two things. One, we had two kinds of supplies. We had office supplies and daycare supplies. Because we don't really know what supplies were paid for on account, whether they were daycare supplies or office supplies, I've combined the totals. And this type of logic is particularly useful when you're also trying to convert from cost of goods sold for the cost of inventory sold to customers to what was actually paid for your cash inventory. We'll use that same type of logic here for supplies. So we're converting from supplies expense on the income statement, $11,700, to how much cash was actually paid for those supplies. And the difference is housed in two different accounts. We know that we might buy supplies that we never used, so the balance in the supplies asset account accounts for some of that difference between supplies expense and cash paid. In this case, we also don't always pay cash for our supplies. We sometimes buy supplies on account. So another difference between supplies expense and cash paid for supplies would be in the accounts payable account. And in this case, we're assuming that all of our accounts payable is related to purchase of supplies. You would want to look particularly at just what the payables are for supplies to do this flop. In any examples that I give you, you'll be assuming that accounts payable is all related to one account. So it would either be like supplies or more commonly for inventories. So using the same logic, we start with supplies expense from the income statement. We go to our balance sheet, and on our balance sheet we see that the supplies account changed by $1,200 during the year. Let's take a look. Supplies started the year at $1,700, ended the year, we're combining these, at $500, so that's a $1,200 decrease in the supplies asset account. Since we have a decrease in the supplies current asset account, our table tells us to subtract it. Now we look at the change in our account payable account. We see that account payable increased during the year by $7,500. Since we have an increase in account payable, chart tells us to subtract it. What we're coming up with is that the cash paid for supplies during year 3 would have been $3,000. Checking back to our direct method cash flow statement, we see that that is indeed what was paid in cash to purchase supplies. So, hopefully you can see that it's very doable to take an income statement number and be able to come up with what the cash flow version of that number would have been. This little tool will help you do that easily.